Good morning and welcome to today's AOD UTP lesson. This is your host and analyst, Jesus Reyes, and we are broadcasting live from sunny and 71 degrees Miami. If you could kindly confirm sound and video to make sure that everything is working okay. Good morning, Kevin. Good morning, Dennis. Good morning, Deb. Excellent. Thank you for those of you who have confirmed so far. And if you haven't done so, please do to make sure that everything is working well on both ends. Elizabeth, thank you kindly for the confirmation, my friend. Thank you very much, Minerva. Good, good, good. All right. So today's AOD UTP lesson will be covering the first three strategies contained within the UTP education. Now, before we, excellent, thank you very much, Debbie, and welcome to the room. Before we begin, make sure that you're logged into the MTI Online University homepage. Once you've done that, please click on Ultimate Traders package. You have a shortcut through the featured courses. And once here, scroll down to where it says Wealth and Freedom Experience Live Event. Download the manual. And then I think it's page 161. (162) of the PDF file. So once you're there, please let me know and we'll carry on. Thank you. I'll give you guys a moment to get to that. Just type in a message so I know that we're all set to continue. Okay, so as you all know by now, these strategies are different ways that MTI has developed these are strategies, different strategies designed and developed by MTI to identify entry opportunities. Now these first three will focus mainly on candlestick formations, to identify entry opportunities. Now they are all designed to identify these entries, but before we look for these signals to get in the market, we need to first analyze the charts to determine in which direction we should be looking to get in. So the first step will always be to determine direction. Now, strategy number one, which is the first strategy that we will be covering, is called scalping candlestick formations inside the ABCD price swing, risking 1 for 1. So again, as we mentioned already, the first step will be to determine the overall direction. We do this by compressing the chart in order to determine whether we should be looking for selling and buying opportunities. By compressing the chart, we see in which direction it's been moving, if it is forming lower lows and lower highs, or higher highs and higher lows. Once we've determined whether the market is forming higher highs and higher lows, or lower lows and lower highs, we get the overall direction. We are going to take charts, the daily and the 2-hour charts, and following that direction from the starting point of that trend, we're going to find and mark all the ABCD swings and sub-ABCD swings that we find until we get the one where the market currently is. So step 1, overall direction by compressing the chart. Then step 2, following that direction, find and mark ABCDs and sub-ABCDs on both the daily and the 2-hour. Now we should only look to apply this strategy in an up or down push zone, or in an up or down retracement zone on the daily chart. Remember that based on the education, we should be looking to trade the C to D part of the swing, and we should be looking to trade in the direction of the larger time frame. So we should look for that push zone for the from the larger time frame and trade it on the daily, on the lower time frame. In this case, we look to identify the setups on the daily, and we look to trade them on the 2-hour. Now when a signal hits, we need to determine which part of the movement we're in. Are we retracing from B to C, or are we in the push zone, or C to D part of the move? You should only be looking to trade in the C to D. Why? That's the movement that fulfills the swing. That's the movement that takes place in the same direction of the overall trend, which makes that part of the move, that movement, the one that will offer a higher probability of success when trading in that direction. We should also keep in mind the time in which we are trading. We will generally find more volume and more directional movement during the active zone that takes place from 2 a.m. to 12 p.m. Eastern Time. From 12 p.m. to 2 a.m. Eastern Time, volume tends to be lower. Now you can look to trade these formations, these candlestick formations. Remember that those will be our triggers, our signals. Look to trade them anywhere that you find them within the AB boundary or sub-ABCDs, as long as you're doing so in the direction of the D, of the capital D. So we mentioned that the trigger will be candlestick formations in the direction of the target. Now please bring your attention before we continue, because this will be this is something that you should all have. On pages 168 and 169, you will find a sheet containing the 5 principal candlestick formations used, and that we should all learn to identify properly, because it will be a key element to trading. Okay? Now that we know how to identify direction, how to set up the charts by identifying and marking the swings, following that overall direction. Once we know if we should be looking to buy or sell, let's talk about the steps from that point onward. If we identify that we are in an uptrend, we should look to buy bullish candlestick formations, which will be the ones found on page 168. Right here. In an uptrend, look to identify bullish shooting stars, bullish morning stars, in bullish engulfing candles, bullish piercing lines, or bullish tweezer bottoms. If you are in a downtrend, then you need to be looking for bearish shooting stars, bearish evening stars, bearish engulfing candles, dark cloud covers, or tweezer tops. So in an uptrend, look to buy a bullish candlestick formation within the AB boundary. Now, where do we enter? If we know that we are in an uptrend and should be looking for buying opportunities, we should be looking for bullish candlestick formations. Make sure that you have those sheets printed out and next to your computer. You need to wait for the candlestick formation to close. Make sure that you have all of the elements necessary to verify the presence of that candlestick formation. Wait for the 2-hour candle, in this case that we're trading off of the 2-hour. Wait for the candle to close. Okay? Not because it looks like the candlestick formation it's going to be there, will it necessarily be at the end of the hour. As soon as you have the candlestick formation, enter at the opening of the next one. So let's say that the candle closes at 4. So at 4:01, you get in buying in this case, since we're talking about an uptrend. If it's a downtrend, same principle. Wait for the candlestick to close. You have all of the candlesticks within the sheet on page 169. As soon as that forms, as soon as that formation is verified, immediately enter at the opening of the following candle. Now that we're in the market, we need to place our stop. How do we determine the stop? How do we calculate it? We have the DTR. The DTR stands for daily trading range, and it's the amount of pips that a pair moves in a day. Now we will use this to calculate where to place our stop. And we will do so by taking the DTR and taking the 10% of the DTR, and that will be the amount of pips below the candlestick formation low, where I'll place my stop if I am buying. Now if I am selling, it will be that same DTR plus the bid and ask spread. Now the bid and ask spread will vary from one pair to the next. Some will have as little as maybe half a pip, and others may have 5, 10, 30 pips. Now, in average, the amount of pairs from the pairs that we generally trade, you will find them to be between 3 and 5 pips, which gives you the opportunity of taking a fixed number. Many traders use 5, and use those 5 pips in addition to the 10% of the DTR to calculate your stop. So if selling, you take 10% of the DTR, you add 5 pips, and that's where you'll place your stop above the candlestick formation high. Any questions so far? Okay, now that we've talked about the entry and the stop, let's talk about the limit. If we go back to the title of the strategy, it says trading candlestick formations inside the ABCD price swing, risking 141, which means that if I'm risking 50 pips, I'm going after 50 pips. If I'm risking 70, I'm going after 70. Now, how do I determine my risk? My risk will be the distance in pips that exists between from my entry to my stop. So once I determine that amount of pips, I know how much I'm going after. Now let's look at some illustrations that we have here. Where we go through examples buying and selling. So in this case, we have a buying opportunity. Buying opportunity. AB at a 618 pullback, the market gives me a bullish candlestick formation. In this case, in the ways of a bullish shooting star. So I will be looking to get in at the opening of the following candle right here. Then I'm going to take the DTR and I'm going to calculate the 10%, and that will be the amount of pips below the candlestick formation low where I'll look to place my stop. Then I am going to determine my risk by measuring the distance between my entry and my stop. And whatever that distance is in pips will be the same amount of pips that I'll be looking to take profit at. Now I can repeat that process every time. Remember, ABCDs and sub-ABCDs as long as you're going towards your D extension. So you had a bullish candlestick formation here. You had a bullish engulfing candle here, which then led to that CTL break. So you could have repeated that process more than once on the way to the D. In a downtrend, it's the same process, save with the stop that will be calculated differently. But we look for a candlestick formation in the direction of the capital D. Here we have tweezer tops. Then we take 10% of the DTR plus the bid and ask spread, which can be fixed at 5 pips. So 10% of the DTR plus 5 pips, and that's where my stop will be above the candlestick formation. I remember that you enter at the opening of the following candle. So in this case, we have a tweezer top. So where do I get in? At the opening of the following candle right here. And whatever the distance is from my entry to my stop will determine the pips that I will be going after. Any questions on strategy number 1? How do we find the DTR? Good question. So if you go to your chart, let's say you're on this or any other pair, click on Windows. No, first click on Services. Click then on Downloads. Once in the download window, look for the Indicators tab. Services, Downloads, Indicators. Scroll down the list of folders until you find one labeled UTP. Then this first indicator that you have called Chiefs DTR is a customized DTR that will calculate the average movement of the pair over the last month of trading. So that's the one that I'll use. Once you download it, it will be saved. To access it, once you have the chart open, click on the indicators tab, on the indicators icon on the left hand column. Then under the MTI custom indicators folder, you'll have all of those organized as you download them. They will be organized alphabetically. And here you find Chief's DTR. So Chief DTR, it's here. I click OK, and now it will show. Here you have 0.913. So that means that you have 91 pips, 91.3 pips DTR. You'll take 10% of that, which becomes 9 pips. And this is a good example because if you are buying, let's say that I'm looking to buy to the 1.618 up here, and when I calculate the DTR, the 10% of that DTR is less than 10 pips, then I will round it up to 10. So I'm buying, I see that I need to place my stop below the candlestick formation that I look to buy from. I calculate the DTR and it's less than 10 pips, then I'll round it up to 10, and that will be the amount of pips below the candlestick formation low from where I will be placing my stop. But if I am selling and it gives me 9 pips, I will take those 9 pips as they are, and I will add the bid and ask spread, which, as we all know by now, you could fix it at 5 pips across the board. So 9 plus 5, 14 pips above the high. I'll place my stop if I were selling. Does that make sense? Are there any questions on this? It shouldn't show 0.00007. I'm not sure why it does that. Did you download the custom indicator, or did you or are you using a different one? Did you download it following the steps that I showed you? Yeah, that's really odd. It shouldn't be showing that. That's 7 pips a 7 pips a day. That's that doesn't make much sense. Yeah. I'm really not sure why it's giving you that number. Because a pair that moves 7 pips a day, it shouldn't, not very much worth trading, I think. So I would do this. Try to erase it, take it off, and apply it again, and see if it looks better. Okay. And let me know if that works. If not, we would need to contact tech support to see if something is off, for them to go into your computer and see if the settings are off. Because if you downloaded them, going back to the workspace, to my workspace, if you downloaded it and you click here on modify, it should use time frame daily over the past 20 days. That would be the equivalent of the past 4 weeks. It should look like this. Oh, Euro USD shows On the Euro US, mine shows 0.00, well, yeah, 670 pips, yeah. I have 0.00693. That would be 69.3 pips, which would be the DTR of 69 pips a day. Yeah, no, that's good then. Now, let's move on to strategy number 2. Strategy number 2 is called scalping candlestick formations inside the ABCD price swing to the B high or B low. So the steps in preparation will be the same. By that I mean we always need to compress the chart to determine the overall direction. Then we need to find and mark ABCDs and sub-ABCDs on the way following that direction from the starting point of the trend to where the current market is. And we do this on the daily and the 2-hour. That will give us the current swing, and we need to identify whether we are in the retracement or the push zone. Remember that you should only be trading in the direction of the C to D price movement. That's the high probability move. Also keep in mind the active zone or dead zone to determine if that will give you an understanding of whether you should be expecting higher, if you should be expecting more or less volume. Remember that regularly more volume will be found during the active zone, hence the name. Now once you have all this, once you know whether you should be looking to buy or sell, then you know which kind of candlestick formations you should be paying attention to, you should be looking to identify. If you're in an uptrend, you should be looking for bullish candlestick formations. If you are in a downtrend, you should be looking for bearish candlestick formations. Always remember that you should always look to wait until the candlestick formation is verified. Okay, don't jump the gun. Don't get in 1 minute before the candle closes because it looks like that's what's going to end up at the end. That's going to end up closing as it looks at the moment. 30 seconds could be enough for the candlestick to change. Once you've verified at the closing of the corresponding candle that the formation is present, then look to immediately get in at the opening of the following one. Once you're in, we need to look to place our stops. And we're going to use the same method that we talked about during strategy number 1. And that is if buying 10% of the DTR below the candlestick formation low. And if I'm selling 10% of the DTR plus the bid and ask spread above the candlestick formation high. Okay? Now the difference here will be placing the limit. On strategy 1, we were going after whatever the same amount of pips that we were risking. In this case, we're going to be aiming the B of the swing. So we're going to look at the price point where that B is, and we are going to look to limit out 10 pips before the B is hit. So how would that look on a potential setup? Using the same that from strategy 1, we have the AB, the pullback to the formation of this shooting star. Once the shooting star has closed, I enter immediately at the opening of the following candle. I'll calculate the DTR, let's say it's 150 pips. Then 10% of 150 would be 15. So 15 pips below the candlestick formation low, 15 pips below the candlestick formation low is where I'll place my stop. Then I'm going to look at the price point where the B high is, in this case, at 1.1128. And I will be looking to get out for profit 10 pips before that is hit, meaning 1.1118. If on the other hand I am selling, it will be basically the same process. By that I mean the signal will be the candlestick formation, in this case the tweezer tops. My entry will take place at the opening of the following candle once the candlestick formation has been verified. I will place my stop 10% of the DTR plus the bid and ask spread above the candlestick formation high. So in this case, if it was 150, it's 15 pips, the 10%, plus 5 pips, it would be a 20 pip stop above the high. And then look at where the B low is. In this case, is 138.07. 10 pips before will be 138.17. Any questions on strategy number 2 and how it works? Let's now move our attention to strategy 3. No, you can use either one of them. There is no preference. It's not it is not a matter of choosing the strategy based on the setup. It is the strategy that best suits you, which one you feel more comfortable with, which one best suits your trading style. So, and remember, we're talking about 1, 2, and 3 today, but we have 7 strategies plus trading fundamental announcements plus 2 additional strategies. So my suggestion would be to read all of them, to go through all of them, to see which one best suits you. If you have more time to follow up, looking to identify and manage positions, you might want to use scalping. If you have less time to go through the charts and follow up on trades, you might use those that are more long-term, like swing trading, and so on. And based on that, determine which entry strategy best works for you. And that's why you'll see that we have 3 strategies and we're using the same ABCD swing, because all 3 strategies could be applied equally. It all depends on which one best you feel more comfortable with. And that brings us now to strategy 3. Now this one is labeled trading candlestick formations. So now we've lost we've replaced the word scalping for trading candlestick formations inside the ABCD price swing to the D. So we're no longer scalping, which is taking different entries within a one whole swing, but trading the candlestick formation all the way down to the fulfillment of the swing at the D extension. So the setup will be the same. We need to determine whether we are in an uptrend or a downtrend, and we'll do that by compressing the chart. Then we need to find and mark ABCDs and sub-ABCDs all the way down to current market price, and do that on the daily and the 2-hour. Once that is done, we need to keep in mind that we should only look to trade this in the push zone or the retracement zone on a daily time frame. When a signal hits, determine whether you are in a pullback or if you're in the B to C retracement move or the C to D extension of the recent or current ABCD swing. You should only be looking to trade this in the C to D price move. Know that if you're trading in the dead zone, you might see less volume, and as a consequence of that, less directional movement. You can trade this within the C to D, within the capital AB or the sub ABs in the direction to the capital D extension. The entry will be the same. We're using here, the common element will be candlestick formations. That's my signal. If I'm in an uptrend, I need to look for bullish candlestick formations. If I am in a downtrend, I need to look for bearish candlestick formations. So once again, it is important, and I reiterate my invitation for you to print these out and have them next to your computer. Once you're in the market, by entering at the opening of the following candle, we need to place our stop. We should always place trade with a stop. A protective stop order at 10% of the DTR plus the bid and ask spread beyond the A when selling. Now in this case, since we are trading the whole swing, our stop will go above the A. We're not scalping anymore. We're going for the D extension. So placing the stop beyond the A will always be the safest place for the stop. If I'm buying, I'm going to use 10% of the DTR and that amount in pips below the A. If I'm selling, 10% of the DTR plus the bid and ask spread above the A. Now to determine my limit, I'm going to use the same approximation that I used on strategy 2. And by that I mean I'm going to identify where the D extension is in price, and I'm going to take profit 10 pips before the market hits the D extension, which is the same approach that we used on strategy 2 in regards to the B. So going through some illustrations where this strategy is applied, we have the AB, we have the same bullish shooting star. Entry takes place at the opening of the following candle. Stop is 10 pips, 10% of the DTR below the A. So we said 150 pips on the previous example. That would mean 15 pips below 10955. So that would mean that my stop would be at 10940. 15 pips. 10% of the DTR below the A. And where would I be limiting out would be 10 pips before the D extension is hit. The market pulled back to a 618, which projects the D to the 1.618. And the 1.618 has a price point of 1.1236. So 10 pips below that will be 1.1226. And that's where I'll limit out at. If selling, same principles applied in the opposite direction, save for the stop. We have a down AB. The market pulled back to a 618 where it formed a pair of tweezer tops. I enter at the opening of the following candle. I then use the 10% of the DTR plus the bid and ask spread, and that will be the amount of pips above the A where I will be placing my stop. After that has been taken care of, I need to look to limit out, or where to establish my limit. 10%, 10 pips before the D is hit, with a D at the 1.618 based on the pullback, would be 137.75. 10 pips before that will be 137.85, and that's where I'll limit out. Any questions on strategies 1, 2, or 3? Okay, excellent. Thank you very much. Well, with that, we've come to the end of today's AOD UTP lesson, where we covered strategies 1, 2, and 3 of the education. You know where to find the manual now, where to read and go through this. And if you go back up to the table of content, you'll find, for those of you that are newer, we covered this, but we have strategy 4, we have 5, 6, 7, strategy 8 with it, which is trading fundamental announcements, and we have 2 additional strategies. So go through all of them, see which best suits the time that you have, the trading style that you feel more comfortable with, and then look to apply that on a demo account to make sure that you dominate the entries, the stops, the limits, how to identify the entries based on each strategy before you decide to move that to a live environment. Having said that, I want to thank you all for joining. I want to thank you all for your participation. If you want to join me via Analyst on Demand, we will be wrapping up at 12. So that will go through the potential trades to be taken, or the ones that I'm looking to take maybe today, and the ones that I may have open. Here you have it, trading AOD, 12 p.m. Just click here and you'll be automatically registered. Again, thank you. Have a great day. And until next time, this is Jesus Reyes signing out.